Good afternoon, everybody. Uneducated Economist here. So I've been doing a lot of reading today. I've been doing a lot of research, and I came across some articles. I came across some papers written, some speeches, and when I put it all together, it really led me to believe that they were anticipating this exact moment in our economic downturn. And even though there's a lot being said about the coronavirus being a self-inflicted wound when it comes to the economic downturn and like the lockdown and, the whole slowing down of the economy and, unemployment and stuff like that. After reading all this stuff, it really leads me to believe a lot more of the stuff that like Peter Schiff has been talking about. And not saying that I was disagreeing with Peter Schiff, not by any means. I just wasn't, going one way or the other on the sides. I was just trying to focus in on what is happening and trying to understand what's going on. But after reading all this stuff, I really, really am thinking that Peter Schiff was very much on the right side of the boat when he's saying that, we would have had this economic downturn despite the coronavirus, because everything that they're talking about here was, especially from the past, is really what seems to be taking place right now in the economy. Now, I want to start it off with this quote from the Boston Fed vice president and economist Jeffrey Thompson. He says, "If we do not see a dramatic resumption of employment and we do not see an extension of those unemployment insurance benefits, then the scenario quickly looks much closer to the worst case scenario." So this is very, very concerned sounding. And he goes on to say, actually, in this, I think this came from Lawyers, Guns, and Money blog, but it says, on Tuesday, President Trump told Republican senators he wanted to allow the enhanced unemployment benefits to expire in July. So this guy is saying, some pretty scary stuff there as far as being the worst case scenario for the economy. Now, this speech comes from Richard Clarida, and this, let's see, I think this was May 21st, so it was just the other day that he gave this speech. And now what I found interesting about it is that he said the unemployment rate, which was at a 50-year low of 3.5%, and as recently as February, surged in April by more than 10 percentage points to 14.7%, an 80-year high, and it is likely to rise further in May. To put the numbers in some context, more jobs were lost in March and April of this year than had been created in the previous 9. So basically, he was saying that all the jobs that were created since the great financial crisis pretty much disappeared in March and April. And now he goes on to say this: The actions the Federal Reserve took at our March 15th meeting, the subsequent announcement over the following days of the creation of 9 new credit facilities to support the flow of credit to households and companies, the robust expansion of our existing foreign exchange swap agreements with major foreign central banks, and the establishment of the new FIMA, Foreign and International Monetary Authority, repo facility, with the potential eligibility for a broad range of countries. While this easing of financial conditions is, of course, welcome, whether it proves to be durable will depend importantly on the course that the coronavirus contagion takes and the duration of the downturn that it causes. At a minimum, the easing of financial conditions is buying some time until the economy can begin to recover. Growth resumes and the unemployment begins to fall. He goes on to say, there is an unusually wide range of scenarios for the evolution of the economy that could plausibly play out over the next several years. In my baseline view, I do believe it will likely take some time for the economic activity and the labor market to fully recover from the pandemic shock. I do project right now that the economy will begin to grow and the unemployment rate will begin to decline starting in the second half of this year. So even in that, what he says there, in my baseline view, while I do believe it will be likely to take some time for the economic activity and labor markets to fully recover from the potential shock, but yet the president over here, the vice president, Jeffrey Thompson, says, if we do not see a dramatic resumption of employment and we do not see an extension of those unemployment insurance benefits, basically saying that if this doesn't pick up like right now, the scenario quickly looks much closer to our worst case scenario, which is probably pretty bad. I mean, you think about the worst case scenario, which would be like, what, a full economic collapse? Anyhow, I don't know. He didn't say what a full, worst case scenario would be there. My projection is for the COVID, this is back to Richard Clarita, and he says, my projection for the COVID-19 contagion shock to be disinflationary, not inflationary, and the data that we're seeing so far are consistent with this projection. For example, core CPI, the consumer price inflation, prices fell 0.45% in April, the largest monthly decrease since the beginning of the series in 1957. So that's pretty heavy. I mean, you think about it, my projection is for the COVID-19 contagion shock to be disinflationary, not inflationary. So right there, they're trying to blame this whole thing on the COVID. Like, look over there, not over here, but over there, because it's the coronavirus that's doing this, not anything else. And then he goes on to say, for example, the core CPI prices fell 0.45% in April, the largest monthly decrease since the beginning of the series in 1957. So this is a pretty dramatic amount. Now, I understand like a lot of people would probably look at the inflation back then and the inflation today and say, hey, these two things aren't even comparable to each other because they're not even judged the same way. But even going by their own numbers here, it's the worst since then. And that's pretty dramatic, considering that if you would probably judge it the way they did back then, it would be even worse. So anyway, I believe will be for aggregate demand to decline relative to aggregate supply. So the demand is going to fall more than the supply will, both in near term and over the medium term. If so, this decrease will put downward pressure on core inflation, which was already running somewhat below the 2% objective when the downturn began in March. Now, just kind of remember that one, okay? Because what he is saying right there, it was already running somewhat below the 2% objective when the downturn began in March. He goes on to say, since March 3rd, we have deployed our entire toolkit to provide critical support to the economy during the challenging times. So that's another interesting statement right there, because you think about it, it was just like, okay, we got a problem here. Yeah, what'd you bring? And it was just like, I brought my entire toolkit and we've deployed it. We've got all our tools working right now. Right? So that leaves me to believe, well, what do you got left? We don't have anything left. We just have these tools. We just got what we're using right now. So we have to invent some new stuff if we want to use it. He goes on to say here, on March 16th, we launched a program to purchase Treasury securities and agency mortgage-backed securities in whatever amount needed to support smooth market functioning, thereby fostering effective transmission of monetary policy to the broader financial conditions. So right there, you're saying that, we've stepped into quantitative easing, and quantitative easing unlimited is pretty much what he is saying right there. Purchasing treasuries and agency mortgage-backed securities at whatever amounts needed to support the smooth market functioning. Goes on to say, since March 17th, the Federal Reserve Board has announced the establishment of no fewer than 9 new facilities to support the flow of credit to households and businesses. These programs are authorized under emergency lending powers granted to the Fed under Section 13.3 of the Federal Reserve Act and are available only in unusual and exigent circumstances with the consent of the Secretary of the Treasury. Very interesting in there, right? Because what he is saying right there is that they would not be able to do any of this stuff if it wasn't for the unusual circumstances of this COVID virus and the exigent circumstances that it created, and with the consent of the Secretary of the Treasury. Now, those 9 new facilities, I found a great article out of Bloomberg that talks about these things, and I'll leave a link down in the description for it. And maybe we can do a video talking about the 9 new facilities that they're referring to. But we'll go on here. These programs are designed to offer backstop sources of funding to the private sector, and just the announcement of these backstop facilities would soon be launched appears to have bolstered confidence in the capital markets, allowing many companies to finance themselves privately even before the facilities were up and running. You guys hear that? Okay, so a lot of us have talked about credible threats in the past, and that is certainly one of them. Okay, and we'll talk a little bit about credible threats in the future, but just kind of remember this. These programs are designed to offer backstop sources of funding for private sectors. That's what the programs are for. And just the announcements that these backstop facilities would soon be launched appears to have bolstered confidence in the capital markets, allowing many companies to finance themselves privately even before the facilities were up and running. All right, we're going to go on. When that day comes, when we are confident the economy is solidly on the road to recovery, we will wind down these lending facilities at such time as we determine the circumstances we confront are no longer unusual or exigent. So you think about the quantitative easing program, and what did they say about that the whole time? It was just like, we will unwind our balance sheet, we will go and return to a new normal, and it never happened. I mean, the moment that they tried to do it, everything started going to hell on them, and they had to reverse course immediately. Well, essentially immediately. I mean, it took them a couple of months, but, in the grand scheme of things, it was pretty much they just, as soon as they started unwinding the balance sheet or trying to return to a normal, everything kind of went to shit on them. Okay. It is important to note that the federal statutory authority grants us lending powers, not spending powers. The Fed is not authorized to grant money to particular beneficiaries to meet the payroll expenses of small businesses or to underwrite the unemployment benefits of displaced workers. Programs to support such worthy goals reside squarely in the domain of the fiscal policy. The Fed can only make loans to solvent entities with the expectations the loans will be paid back. Okay, so he says right there that we cannot spend money, we can only lend it into the economy. We are lenders of the money, not givers of wares. Okay. The Federal Reserve will continue to act forcefully, proactively, and aggressively as we deploy our toolkit, including our balance sheet, forward guidance, and lending facilities. So it was a very interesting speech old Richard gave there, talking about the situation that we're in right now. Now, when you step back a few years, now I'm talking back to 2010, I came across, now I have to thank Tim. Tim sends me a lot of stuff, a lot of really, really good stuff. And he has sent me some papers that, from Federal Reserve speeches from 20 years ago that are playing out today. This guy does a lot of research, and I would have to contribute a lot of the information on this channel is because of Tim. And I have to thank you, Tim, very much for all the emails that you send me. And this one came from Tim as well. Today, and this is Chairman Ben Bernanke, who had wrote this article for the Washington Post, and it's called "Aiding the Economy: What the Fed Did and Why." And I'm not going to read the whole thing. There's just a couple of sections in here. Today, most of the measures of underlying inflation are running somewhat below 2% or a bit lower than the rate most Fed and policymakers see as being most consistent with healthy economic growth for the long run. Now, I found that interesting because if you go back and listen to what old Richard Clarita said, I believe will be for aggregate demand to decline relatively to our aggregate supply, both in the near term and the medium term. If so, this decrease will put downward pressure on core inflation, which has already running somewhat below the 2% objective when the downturn began in March. So he was saying that we haven't been really achieving that 2% inflation goal. And what Ben Bernanke said back in 2010 is that 2% or a bit lower than the rate most policymakers see being most consistent with the healthy economic growth. So pretty much we have not had healthy economic growth since 2010 because we've never really achieved that 2% inflation goal. I mean, they've pretty much been running under that the entire time. This approach, and I'm sorry, guys, I guess I should give you a little bit of context here. He's talking about the quantitative easing programs here with, purchasing of treasuries and mortgage-backed securities. But anyway, he goes on to say, this approach eased financial conditions in the past and so far looks to be effective again. Stock prices rose in the long term. Interest rates fell when the investors began to anticipate this additional action. Easier financial conditions will promote economic growth. For example, lower mortgage rates will make housing more affordable and allow homeowners to refinance. Lower corporate bond rates will encourage investment. Now, I have to disagree with that because pretty much since the financial crisis, new home purchases have gotten farther and farther out of reach for the average wages. It did not make homes more affordable. It made them more expensive for people to try and acquire. Goes on to say here, and allow homeowners to refinance. That is very true. The lower interest rates did give homeowners the ability to refinance their homes into lesser, payments. The problem with it is that most of these people, when they refinance their home, they took the equity out, went and spent that on vacation or whatever they did with it. But They didn't just like refinance their home and start making the payments on it. They took the money out. Lower corporate bond rates will encourage investment, which, yeah, I agree with that too, because we saw a huge amount of corporate debt being sold while these interest rates were dropping down. But what did those corporations do with the money? They bought back their own stock, making the stock market rise. Did they reinvest it? I imagine a lot of them did, but a lot of them went back and bought their own stock with it. So, the things that Ben Bernanke were thinking were going to happen didn't really quite happen out to the way that he was anticipating they would. He says, although asset purchases are relatively unfamiliar as a tool of monetary policy, some concerns about this approach are overstated. Critics have, for example, worried that it will lead to excessive increase in the money supply and ultimately to significant increases in inflation. Now, I do agree with that, because he's basically saying that all this effort that they're going to do with the quantitative easing and stuff is not going to increase the inflation, and it really didn't. Like, a lot of people were screaming hyperinflation back then, that all this money printing is eventually going to find its way into the economy and everybody's going to have like this hyperinflation scenario take place. But it didn't occur that way. It just didn't happen. And he goes on to say here, we made all necessary preparations and we are confident that we have the tools to unwind these policies at the appropriate time. Now, I definitely disagree with that, because they never did unwind the whole quantitative easing program. They never returned the balance sheet back to normal, and they did not do anything that was even remotely close to unwinding the thing at the appropriate time. It just didn't happen. So very interesting writings there. Now, this is probably one of my most favorite speeches from Ben Bernanke. It was given back in 2002, and he was talking about deflation, and the title of it is Deflation, Making Sure It Doesn't Happen Here. Now, this is a very long speech, but it is a very good one, and if you have the time to read it, I suggest you do. This is the speech that has the credible threats gold story in it. Now, I'll talk about that here in just a minute, but a lot of you who follow my channel for any length of time, I've talked about the credible threat and the guy who invents the gold machine. This is where I got that from, was this speech. Now, in this, he says, however, a deflationary scenario may differ in one respect from normal recessions in which the inflation rate is at least modestly positive. Deflation of sufficient magnitude may result in the nominal interest rate declining to zero or very close to zero. Once the nominal interest rates is at zero, no further downward adjustment in the rate can occur, since lenders generally will not accept negative nominal interest rates when it is possible instead to hold cash. At this point, the nominal interest rate is said to have hit the zero bound. All right, so it's kind of funny how back then they were talking about negative interest rates, thinking that it wasn't even a feasible possibility, and yet here we are talking about negative interest rates as a feasible possibility. Anyway, going on here, he says, because central banks conveniently conduct monetary policies by manipulating the short-term nominal interest rates, some observers have concluded that when the key rate stands at or near zero, the central bank has run out of ammunition. That is, it no longer has the power to expand aggregate demand and hence economic activity. It is true that once the policy rate has been driven down to zero, a central bank can no longer use its traditional means of stimulating aggregate demand and thus will be operating in a less familiar territory. The central bank's inability to use traditional methods may complicate the policymaking process and introduce uncertainty to the size and timing of the uncertainty in the size and timing of the economy's response to policy actions. Hence, I agree that the situation is one to be avoided if possible. But he goes on to say here, deflation is generally the result of low and falling aggregate demand. The basic prescription for preventing deflation is therefore straightforward, at least in principle. Use monetary and fiscal policy as needed to support the aggregate spending. So that seems pretty simple. It was just like, when you start running into deflation, do something about it. That's pretty much what he is saying there. Goes on. The Fed should take most seriously, of course it does, its responsibility to ensure financial stability in the economy. Goes on to say, a healthy, well-capitalized banking system and sorry guys, I guess I should talk a little bit more about this before I start in on that. He says that there's basically three ways to prevent deflation. And the first way he talks about is to let inflation run high, like to have like overinflation. And then when deflation starts to kick in, that hopefully the inflation will drop down into that kind of target range so that you don't have deflation taking place or the disinflation. So he was saying at first is to allow inflation to run hotter than what you would typically let it go. That's the first way to prevent it. The second way to prevent deflation was to keep a healthy, well-capitalized banking system and smooth functioning of capital markets are an important line of defense against deflationary shocks. Now that led me to think about September and the overnight repo agreements that they were conducting for however many months before the quantitative easings really started kicking in. But that overnight repo facilities that they were doing, that kind of reminds me of that statement right there for the second way to prevent deflation. A healthy, well-capitalized banking system and smoothly functioning capital markets are an important line of defense against deflationary shocks. Third, he goes, as suggested by the number of studies, when inflation is already low and the fundamentals of economies suddenly deteriorate, the central bank should act more preemptively and more aggressively than usual in cutting rates. So back when we saw the Federal Reserve reverse course as far as unwinding their monetary policy, and then they started dropping interest rates, that was them acting preemptively to keep the deflation from kicking in. So those three things pretty much occurred, as far as what's happened here just recently within the last year. Goes on. I believe that a combination of strong economic fundamentals and policymakers that are attentive to the downside as well as the upside risk to inflation makes significant deflation in the United States in the foreseeable future quite unlikely. But suppose that, despite all the precautions, deflation were to take hold in the U.S. economy, and moreover, the Fed's policy instrument, the Fed funds rate, were to fall to zero. What then? So what would happen if we land at this exact moment, right? So if you, not back then in 2002, but right now here in, 2020, what would the Federal Reserve do if the deflation started kicking in and the Fed funds rate were at zero? What do you do about that? And this is what he says, curing deflation. He says, some observers have concluded that when the central bank's policy rates have fallen to zero, its practical minimum, monetary policy loses its ability to further stimulate aggregate demand in the economy. At a broad conceptual level, and in my view, in practice as well, this conclusion is clearly mistaken. Indeed, under a fiat, that is paper money system, a government, in practice, the central bank in cooperation with other agencies, should always be able to generate increased nominal spending and inflation even when the short-term nominal interest rates are at zero. Now, he goes on to talk about the gold story. He has a little story written here. I'm not going to read it, but I'll just tell you how it goes. And that's basically the guy who invents a gold machine. And with this gold machine, he can produce as much gold as he wants at will with very little cost or energy. The moment that information gets out to the public that he has this machine, the price of gold on the market will just immediately plummet, even before the guy produces a single ounce of gold. Just that information alone, the credible threat that he has this machine, would be enough to move the markets. He goes on to say, what has this got to do with monetary policy? Like gold, U.S. dollars have value only to the extent that they are strictly limited in supply. But the U.S. government has a technology called a printing press, or today its electronic equivalent. That allows it to produce as many U.S. dollars as it wishes at essentially no cost. By increasing the number of the U.S. dollars in circulation, or even by the credible threat of doing so, the U.S. government can also reduce the value of the dollar in terms of goods and services, which is equivalent to raising the prices in dollars of those goods and services. We concluded that under a paper monetary system, a determined government can always generate higher spending and hence positive inflation. Now we go back to old Richard's statement here the other day in that speech where he says, where was it? These programs are designed to offer backstop sources of funding to the private sector, and just the announcement that these backstop facilities would soon be launched appears to have bolstered confidence in capital markets, allowing many companies to finance themselves privately even before the facilities were up and running. See, the credible threat alone. All right. Of course, the U.S. government is not, and I like this one. Of course, the U.S. government is not going to print money and distribute it willy-nilly. Are you sure? Okay. Normally, money is injected into the economy through the asset purchases of the Federal Reserve. To stimulate aggregate spending, when short-term interest rates have reached zero, the Fed must expand the scale of its asset purchases or possibly expand the menu of its assets that it buys. Okay, we're starting to experience that right now with the, purchasing of the mortgage-backed securities, the purchasing of municipal bonds, the corporate bonds. We're starting to see the menu of what they put on their balance sheet start to expand, just like Ben Bernanke said it would back in 2002. Because the long-term interest rates represent averages of current and expected future short-term rates plus the term premium, a commitment to keep short-term rates at zero for some time, if it were credible, would induce a decline in the longer-term rates. A more direct method, which I personally prefer, would be for the Fed to begin announcing explicit ceilings for yields on long maturity treasury debt, say bonds maturing within the next 2 years. The Fed could enforce these rate ceilings by committing to making unlimited purchases of securities for up to 2 years from maturity at prices consistent with the targeted yield. So basically what they're saying is that if they promise to make sure that short-term rates are only allowed to go to a certain level, that everybody's anticipation of that would force the longer-term rates down as well. He goes on. If lowering yields on long-dated Treasury securities proved insufficient to restart spending, however, the Fed might next consider attempting to influence directly the yields on privately issued securities. You guys hear that one? All right. This is like the privately issued securities. That's corporate debt. Unlike some central banks, and barring changes to current law, the Fed is relatively restricted in its ability to buy private securities directly, right? Unless there's unusual and exigent circumstances, like old Richard says. However, the Fed does have broad powers to lend to the private sector indirectly via banks through the discount window. For example, the Fed might make 90-day and 180-day zero-interest loans to banks, taking corporate commercial paper at the same maturity as collateral. So some of those things that we're starting to experience right now with the special purpose vehicles. Okay. What else does he say here? The Fed can inject money into the economy in still other ways. For example, the Fed has the authority to buy foreign government debt, as well as domestic government debt. Potentially, this class of assets offers huge scopes for the Fed's operations, as the quantity of foreign assets eligible for purchase by the Fed is several times the stock of the U.S. government debt. Now, that leads me back to old Richard's talk here, where he says, the establishment of the new FIMA, Foreign and International Monetary Authority repo facility with potential eligibility for a broad range of countries. Sounds like very much what Ben Bernanke was suggesting that we could use as far as being able to purchase foreign debt and put that onto the balance sheet. Goes on to say here, if all these things don't really work out, fiscal policy can be used. Now, this is the government's stimulating the economy as opposed to the Fed's actions. A broad-based tax cut, for example, accommodated by a program of open market purchases to alleviate any tendency for interest rates to increase, would almost certainly be an effective stimulant to the consumption and hence to prices. Broad-based tax cuts, corporate tax cuts, payroll tax cuts. All right. Even if households decide not to increase consumption, but instead rebalance their portfolios by using their extra cash to acquire real and financial assets, the resulting increase in asset values would lower the cost of capital and improve the balance sheet position of potential borrowers. Any money finance tax cut is essentially equivalent to Milton Friedman's famous helicopter money drop. All right. So talked about taxes. Okay. If the Treasury issued debt to purchase private assets at the Fed, then purchased an equal amount of Treasury's debt with newly created money, the whole operation would be the economic equivalent of direct open market operations in private assets. So the Federal Reserve can't do it, but if the Federal Reserve says, hey, I'll buy a bunch of treasuries, and if the Treasury went and bought these private assets, then, that's kind of the same thing, but we're not doing it, you're doing it. And that kind of reminds me of the TARP program, the Troubled Asset Relief Program. Anyway, found that to be very interesting stuff. It leads me to think more about how this coronavirus is used more as a scapegoat for the economic downturn than an actual cause for the economic downturn, considering that everything that they were talking about being a possibility for deflation in the future during the next economic downturn and how great it could be is now taking place, and they're using all those tools right now, and it's all the tools that they have in their playbook. It's very interesting stuff. And I'll leave links down in the description for all these things. I know that video, I kind of stumbled through a lot of it. I hope you guys got through it. It was, there was a lot there. But like I said, I'll leave links down in the description for everything. And I would love to get you guys' response on that one. Uneducated Economist. You guys let me know.